And we are all set. Everybody see that okay?
Yes.
Awesome. To start, today's class is on basis. Now, I know that everybody has a problem with basis. And they usually do because they think that basis is so hard. Basis is basically a very stupid word to use for cost. I don't know why they call it basis. It makes it seem so complicated. It's not. It means the cost of an asset, okay? When they say basis of business assets, it makes it confusing. Okay, when I say the basis of a business asset, you start trying to figure out what does it mean by basis. Basis is ridiculous to call it that because here's the truth. Basis is a business asset, is any type of property used in the conduct of a trade or business. We know that. And it can be tangible or intangible. And well, let me go through this. I gave you these publications, by the way, and the forms. But what is basis? Okay. And by the way, were you able to download all these forms, guys?
Yes.
Able to get them? Okay. Because that was the two publications, basis of assets and casualties, disasters, and thefts are the two most important ones. Okay. So what is basis? And that's the big question here. Because everybody wants to say, what is basis? I don't understand it. I don't know what it is. Basis is, this is the most simple definition. Any cost associated with the purchase of an asset. How much did the asset cost you? Okay? Guys, it's not that hard. Okay? It's the cost of an asset. That's what basis is. Okay? It should never be called basis. It should be cost. Okay? And it can be the sales or use tax on a purchase, the freight to obtain the property. So in other words, if something is being delivered to you, shipping and handling, pretty simple. Installation and testing costs. Does it cost money to set it up? Does it cost money to have it delivered? Does it take money to have it tested? If you're having property, do you have testing beforehand? Do you have to test the property beforehand? Are you going to build something on it? So you have to have land evaluations. Okay, it's really simple. Excise taxes. Guess what? When you buy property, there may be an excise tax on it. If you're buying cigarettes, maybe you're a tobacco sales company. You're a gas station, and you need to buy your supply of cigarettes. Guess what? You may have to have excise tax somewhere. Okay, so it's very simple. It's part of your cost of buying your inventory. Legal and accounting fees. Your legal department, you're writing something up, you're writing up a contract for something, you're purchasing it, you're buying a piece of property, you have to have the real estate fees, the attorney fees, whatever it may be. Revenue stamps. Do you know what revenue stamps are? Tax stamps. Okay.
Yeah, documentary stamps.
Document stamps. Okay, that's what they are. They're very simple. They cost money. That's part of the cost of getting an asset. Recording fees. You buy a piece of property, guess what? It gets recorded with the county. You buy a car. There's a title on a car. It has to be recorded with the DMV, okay, with the state, the Department of Motor Vehicles, okay, the licensing. All that has a cost. The sales tax, okay, pretty simple. Real estate taxes. Now, real estate taxes, if they are assumed by the buyer. So if the seller is paying it, guess what? That's their expense, not yours. But if you're taking on the real estate tax, that's your expense. So if you're buying the property, you're having that expense. So yes, it is an expense you have for buying it. Settlement costs, okay? Anything, the closing costs on a property. Settlement costs, like I said, there are any kind of closing costs on any kind of transaction could be a settlement cost. Okay, guys, this is everything associated with buying anything, and that is the sum of these is what it costs to purchase anything. And it's very simple. It's not complicated. All of these are associated with buying piece of property, a patent. If you want to buy a patent, if Monsanto, the fertilizer company wants to buy up a patent for something, guess what? They have to research it. They have to find out who legally owns it. They have to do a title search. They have to do the patent search. They have to find out who actually owns it. Then they have to actually purchase it, write the offer, have the legal fees. Then they have to submit it. They have to then file it. And then they have to register with the U.S. Patent Office that they're now the official owner of it. Okay, they now own a patent. That all led to what that patent cost. That's the basis. When they say basis, it's not just the actual dollar amount on the, the sticker price in the window of the car. Okay, that is not the price associated with the car. It's the total cost that it costs for that car. All right, at the time of purchase. Now remember something. There's a difference though between what it costs at the time of the purchase and things to maintain it. So we'll get into that in a little bit, because there are maintenance fees that are different than your basis cost, because your basis is what it actually costs to purchase it. And that is carried on throughout the value of the property. Okay. All right, let's keep going here. So, basis of real property. Do you know why this is called real property? Do you know what?
Because the real estate.
Thank you. Do you know what that word actually is? It's not real. It's actually European. It goes back farther than that. That is actually royal. That is of the reals. Okay. If you go back farther, that is the official root of the word royal. Okay. And most people don't know that unless you've been associated with real estate. Okay. Property of the royals. So in other words, property of the monarchy. So, most people do not know this. You never actually own real estate. You actually get to have a long-term control lease that you own. It's actually always owned by the country, or in this case, by the country, followed by the county, followed by the state, followed by the county that it's in. Okay, so that's the way it actually falls, but you actually just get a long-term lease for it. That's why the county can take it away. Okay, you can sell your rights to it, you can pass those rights along, but in the end, the county actually owns it forever. Okay, but it is the property of the reals, or in the actual translation is the property of the royals. So that's how you distinguish what we're talking about. If it says real property, it means real estate. If it says personal property, it is your items. Okay, so that's the way you always distinguish between the two. Real property always means real estate. Okay, now with real estate, there are a number of parts for real estate that you have to kind of understand are always associated with it, no matter what piece of property is, where it is, doesn't matter. There's always certain things that are associated with real estate. Okay. Number one, settlement costs. Okay, when you transfer a piece of real estate, right, no matter what happens, there will be settlement costs. That's because it costs money to transfer real estate with the county. All right, they charge a fee. They usually don't do it for free. Actually, they never do it for free. So when property actually transfers hands, there's always a settlement cost. And depending upon where you are, there may be an excise tax from the county on all property. In Clark County here in Washington, in Southwest Washington, there's an excise tax on all property sold. Okay. So when you do exchange, now by this, remember something. I'm talking about actually purchasing property. because there's a difference between leasing a piece of property and purchasing a piece of property. Okay, and a lot of people assume that they are really the same thing. They are not. Okay, they think when you take possession of the property, it basically is, in a sense, the same thing. It is not. Okay, when you lease a piece of property, you only have certain rights to it. When you buy a piece of property, you have rights that you are buying with it. You have mineral rights, right-of-ways, things like that. That's what you're actually buying. So remember something. There are settlement costs with that in every case. All right, just a sec here. I'm trying to pull this one up. Okay, there it is. Okay. Real estate taxes. Okay, settlement costs are the cost to close a piece of property. Real estate taxes are the cost to own the piece of property. Now, we have real estate taxes. They are assessed by the counties. They are the operating costs of the counties. They are based on usually an assessment value of what the property is worth. And the county controls it, and that is the county fees to maintain the operation of the county, fire, police, that sort of thing. Okay. They can, if you have real estate taxes, now for those people who don't understand how it works, real estate taxes are assessed on a daily basis. Okay. By daily basis, it means that if you buy a piece of real estate, you have it up until the day of purchase. Okay. Anybody know who is responsible for the real estate taxes on the day of closing?
On the day of closing is the buyer.
There you go. Thank you. That's the important one. Most people don't know who is responsible for the taxes on the day of closing. It is the buyer. Okay. What happens is the seller is responsible up until the day before closing. Okay. On the day of closing and for the rest of the tax year, the buyer is responsible. Okay. So what does that mean? When you close, let's say I'm closing on July 3rd. Okay. So up to July 2nd, the seller is responsible for all taxes. So for all the days, and it's counted as 365 days, okay, it goes on a daily basis. For the first up till July 2nd, the seller is responsible. From July 3rd through December 31st, the buyer is responsible. Okay? Understand how that works? It's
Yes.
it's very specific. The reason I say that is because a lot of people don't know who is responsible. They think that the seller owns it that last day. The seller does not own it on the day of closing. The seller owns it up to the day of closing. The day of closing forward, the buyer technically owns it. Okay, at least for tax purposes. All right, so in regards to taxes, and this is really, really important because this is actually asked for a lot of people. Taxes are paid by the seller up till the day of closing, up to that day. The day of closing and forward is the responsibility of the buyer. Okay. All right. Real estate taxes are pretty simple. If, however, the seller can assume taxes, the buyer may or may not be able to add them to the basis cost. Okay, because it wasn't part of their expenses. So in some agreements, now this is very rare, but when you ask, remember a lot of people ask for closing costs. right? There are also times when they will ask for closing costs and taxes for the full year. It's rare, but it does happen. Remember, that's why it says real estate taxes if paid by the buyer. Okay? If paid by the seller, it's not part of your cost. Okay? So understand that. That's the difference. If the buyer is doing the normal assumption of the taxes, so in other words, as of the day of closing, it becomes the buyer's responsibility for the taxes, then it becomes part of the cost of purchasing that property. If the seller, however, has agreed to cover the taxes for, maybe they've already paid it, maybe they're closing, as you guys probably may or may not know, taxes are usually, now this is a usually, paid twice a year, normally in April and in October, just like the regular income taxes. Property taxes are usually the same way. Okay, so what happens is, let's say it's November when you close on the property. All right, the seller may have already paid all the taxes. Okay, for the whole year. You may have paid all the taxes for the entire full year, and as a result, he'd be getting a refund of those taxes, and the seller, then the buyer would be getting a bill basically for the remainder of the year of taxes. Okay, so instead of doing that, sometimes the seller just agrees to pay the remainder of the taxes. That would be one of the rare cases where it does occur. Okay, so as a result, in that case, the buyer did not assume the taxes, so it is not part of the basis. Okay, are we clear on that one?
Yes.
Okay, so if the buyer does not assume the taxes, if the buyer does not pay the taxes, it's not part of the basis. Only if it's done the regular way. Okay. All right. Let's continue on here. Where's my mouse? Assumption of a mortgage. If a taxpayer buys property with an existing mortgage, the existing mortgage ends up as part of the cost plus the cost to assume that mortgage. Now, let me pull up the whiteboard so you guys understand how this basically works. Assumption of a mortgage is a way a lot of people buy property or have bought property in the past. What it does is this. When
It's done a lot with VA loans.
Very much so. Because VA loans were assumable. A lot of them are no longer assumable, but for a long time they were. So this is my loan. This is the existing loan on the property. Okay. So what I have is that's my existing loan. And what I do is I want to sell the property. Let's say it's an elderly couple or something. They've had this property for a number of years and they've been paying off the loan. And let's say they want to sell the property and the buyer comes in and says, tell you what, I know you want to sell the property for this amount. Let's go ahead and leave your mortgage in place. I'll assume your mortgage, and because usually it's at a much better interest rate, by the way, or it was, and I don't have to get a loan. I'll just pay you the difference. And sometimes they get it as a second loan, sometimes they get it as whatever, but they get basically a wraparound loan. So they get a second loan that they pay them this difference. This is the new amount. So they pay them either cash or a second loan. So this is cash or a second loan for that amount. Okay. That second amount is the additional amount in cost. Okay, so when this will combined, So if we do this, this is loan one plus loan two equals the total sales amount, total sale price. Okay, which would be your total cost. That would be your total basis there, plus the settlement costs and all. But that's what you would look at as your basis cost. So when you assume a mortgage, this would be loan two would be the cost to assume that first mortgage. Okay, that's how it's looked at, because this is what it costs you. This here, let me put this here. This amount is what it basically cost you to assume this amount. Okay, you see how that works?
Yes.
So, and they may pay it in cash. This may be, this first loan may be still $300,000, and this may be only $50,000. So they can get a loan for $50,000, a second loan somewhere. They bring it to the people, give them the $50,000, and just assume their loan. Because think about it, what are the people going to get at closing? If they already have this loan on the property, how much are the people going to get at closing?
The $50,000.
They're going to get this amount. That's how much they're going to actually get, minus any settlement costs and that sort of thing.
And I have a question. When you're doing settlement costs, the cost of getting the actual loan is not included, right?
Mortgage costs are usually not part of it, correct? You know, so points and that sort of thing are usually not as part of basis. So, but in this particular case, because this is actually the loan itself or the cost itself, because the cost is this plus this basically, that'll give you the total sales price. Because when they ask you how much the total sales price, it's going to be this amount. It's this loan plus this loan. How it gets divided up, because the couple is never going to see this amount anyways. They're only going to see this amount. That's the sales price. Okay. So, but the actual points on the mortgage, no, that's not part of the basis, because that was actually the cost of getting the loan. Now, we will get into it because there are some parts of a mortgage itself that are actually deductible, but that are part of the basis, but they're usually not, they're not part of the basis. They're part of an expenditure, because when you think about it, that's not part of the asset itself. Okay, your loan cost is for the loan, not the property. Do you understand what I'm talking about in that sense?
Yeah.
Yeah, because the cost of the loan, the cost for the points for the loan, are what the actual loan cost. Your asset, which is the property itself, is this loan amount plus the second loan amount, which is the sales price. That's what makes up the sales price. Okay.
But your assumption of the mortgage is not included in the basis?
Yes, you're the assumption amount, because that's part of the sales price. Remember, this thing is your actual cost of the property. If you're writing up a contract, if I'm writing up a contract, the contract sales price would be this amount. I'm buying this property. Let's say that this is the first loan, which is their existing loan. Let's say it's 200. Let's do it this way. Text. There we go. Let's say it's 200,000, or whatever it is. It's 200,000 plus the second amount. Let's say it's 50,000. Say they did really well, and they're getting this property for 250,000. That means the sales price of this property is how much? $250,000. That's what the contract will say. This amount will actually be what is on the purchase and sale agreement, $250,000. When I go to buy that property, it's going to say ABC company is buying this property for $250,000. So for all intents and purposes, this assumption of a mortgage is included in the basis. The only thing is it doesn't matter that you're assuming the mortgage. It is, because people get confused by it. I think that's part of the problem here, Naomi. You're assuming that this has anything to do with a mortgage. It doesn't. Okay? Because this is the only part that matters, is that $250,000. That is the cost of the property. Okay? To get the property, you are basically having a second loan for the $50,000, and you're assuming their first loan. They have an existing loan for $200,000. Because at closing, what are they going to get for the seller? What's going to happen for the seller? Because does it matter really to the seller?
No, it doesn't. He just gets his cash.
Because what's going to happen? We're going to pay them $250,000, right?
Yes.
And then it's going to be minus $200,000. To miss a line, but it's minus $200,000 for the loan, because that goes to, the bank to pay off that loan. And then you're going to have $50,000, minus the $50,000 is going to go, well, or should I say that's going to leave, let's do it this way. That's going to leave $50,000 to the seller.
Cash.
Cash to the seller.
Yeah.
Okay. And then that $50,000 from there, they're going to take a couple of things out of there. You do know that, because that's going to be minus the closing cost. Any taxes like excise tax. So we'll just do this minus excise tax, things like that, minus agent fees.
Got to get that 6%.
Got to get that, however, got to get my commission out of it, kind of thing. So they're going to get whatever is left.
Any liens too?
Any liens, yeah, minus liens. Okay. Minus any liens. We can go on here. There's a number, so those are the things that's going to come out of it, and whatever's left will be whatever is left will equal a check to the seller. Or possibly a bill to the seller if they're underwater with it. If that may eat up all of the $50,000 and more. So they're basically assuming this, because they're never going to, like I said, with this, they're assuming this $200,000, because the seller's never going to see it anyways. Okay. So it's just part of the cost of the property. I'm just going to basically, when it says assumption of a mortgage, I'm just taking over your payments. Whatever you have left on it,
Yes.
I'm just taking it over.
But why are you deducting the closing cost to the 50,000? I thought the closing cost excise tax will be paid by the buyer.
The seller has
No.
their own.
The seller has
Huh?
their own. Seller has their own.
Ah, seller has their own
Yeah,
closing
the
costs.
seller has their own closing costs, their
Ah,
own
okay.
excise tax is paid by the seller, not the buyer.
But the buyer also have their own closing
Yep,
costs?
the buyer has their own closing costs.
Okay, sorry, I'm not familiar with real
Yeah.
estate.
Oh yeah. Oh yeah, and the liens, agent fees are paid for by the seller.
Ah, yeah, because it's her
Mm,
agent.
Yep. So yeah, all of those are paid for usually. As a matter of fact, one of the things that is usually asked for is the seller will pay all buyer's closing costs. So it probably won't just be their closing costs. It will also probably be the buyer's closing costs too.
Yeah, but
I always,
usually the mortgage goes up and they think they're making more money.
yeah, they're
But
not. I know. But, hey, I always make it sound good. But, yeah, those are all part of it. Closing costs, both sides have closing costs. Both sides have, well, the seller has the excise tax side.
Mm-hmm.
The agent fees are on the seller side. Liens are on the seller side. If there's anything left, then you would end up with a check to the seller. There may not be a check to the seller. It may actually be a bill to the seller. So they may have to bring money to the table.
yeah, sellers aren't happy when they have to bring money to the table.
When they have to bring money to the table, it makes them really upset. You want to see what it costs sometimes? Yeah, it sometimes they're bringing thousands of dollars to the table just to close, and a lot of times they don't have a clue, and they go, "Why am I'm supposed to be making some money on this? I've been paying on this for years." Yeah, you also refinanced it how long ago, and you've been, it's like, and these are the costs that it took. Well, this is, come on, and you're like, this is what it costs to sell property, guys, and they don't get it.
It's too bad because you're at the closing table and you have to close.
Yeah. And what's even worse is when it's on the seller side, when the buyer has met all of his conditions. It's really hard for the seller to walk away because then you get sued for breach of contract. So, yeah, because you can't force a seller to sell. Here's the important thing. Most people don't know this, that for the seller, if he decides that for whatever reason he's not selling, he's like, then I'm not selling it. That's great because you're right. You don't have to sell the property and you can get up and walk away. However, you have a contract now that is a signed around contract that all conditions have been met. That now means you are now in breach of contract.
But if you
Which
have not yet signed it,
doesn't make a difference. You've already signed the contract. Okay, this is a closing is different. So you have to understand there are two contracts. Okay, one is the purchase and sale agreement. That's the first contract. That's the first agreement that is just as binding as the closing. Okay. So a purchase and sale agreement is the original contract between the buyer and the seller agreeing on sales price and conditions for the sale. You have that legally binding contract. Once that legally binding contract is in place, a sale has occurred for the property. It's an agreement to sell the property. Okay, they can't sell it to anybody else. They can't go out and just say, oh, you know what, I don't like your contract. I'm going to go sell it to you. Okay, you already have an agreement to sell it to this person. You can't go sell it to anybody else. You can't agree to sell it to anybody else. You can take a backup offer that is in second place to that first one in case something happens. Now, there are clauses usually in the first one on the buyer's side, not on the seller's side. Okay, but on the buyer's side, that say, I can have the property inspected usually. I'm conditional upon my financing. I'm conditional upon the agreement of my partner, whatever it may be. Now, if something comes up where it is a change must be made, then yes, the seller can back out at that point because they don't have to agree to the change. Okay. But as long as the buyer is performing with all intent to buy the property and is following all the conditions that were set forth in the original contract, that seller is by law required to sell the property.
Mm.
If they decide, however, because they are not they cannot be forced to sell a property. If they decide to not sell it, they are now what is known as breach of contract because they had a contract. They've taken the property off the market. They've done everything they're supposed to. That buyer is now in breach of contract. So that seller or that buyer, okay, if that seller decides not to sell it, he is now in breach of contract, and the buyer can now sue him for the full value of that contract. In other words, the full sales price of that contract he can sell him for, and all costs, all closing costs, everything.
How about if the buyer changed the mind?
If the buyer changes his mind, what it means is now he usually has an out clause. So in other words, that's what the conditions are. That's the inspection. If he doesn't meet with the inspection, then he is given an out there if he doesn't agree with what the conditions of the inspection. If he cannot get financing, then it's an out clause which allows him out there. If there are if it's conditional upon the approval of his partner, all you have to do is submit a written thing saying my partner has denied the sale. He has decided against it, and the contract is now void. Okay, so the partner has denied it. But those are conditional clauses which allow the buyer out. However, once those are waived, is the word I'm looking for. Once those have been met, the conditions have been met, and you are going to close, and the seller is going to close, and the buyer then, for whatever reason, backs out, they have already put up what's called earnest money into escrow.
Yeah.
That earnest money is then forfeit to the buyer, to the seller, and the seller can now sue them for breach of contract. Can now sue the buyer for breach of contract if they want to go after him. Most of them just take the earnest money and just say, well, forget it, because escrow will release it if there is a breach of contract, an obvious seller back out for whatever reason. Escrow will release the earnest money to them. So that's how that works. And that's what the earnest money is for. Wow, that was a quick lesson in real estate, wasn't it?
Thank you.
Yeah, so now you understand how an assumption of a mortgage works.
Yes.
There was much more than we actually needed to cover. But anyway, so now on to the next thing. Let me go this way and get this. There we are. All right. So, assumption of a mortgage, constructing assets. If you buy a piece of land, you have a basis cost for the land. That's the cost to acquire it. Is known as acquisition and development. Once you have acquired the land, it costs money to build property. Okay, to actually build the structures on the property. maybe building a factory, that sort of thing. That is part of the costs that it takes to develop it into a functional factory and a functional facility. Okay, those constructing costs are part of the basis. In other words, that is building permits. You got to pay contractors. You have to rent equipment to build it. Have inspections. You may have to hire construction workers. There's any number of things. The labor itself to develop the land itself, to put in the infrastructure for it, the sewer lines, water lines, electrical, phone, all that have to go in beforehand. Before you even start building it, to prep the land, you actually have to have an analysis of the land itself. All of these are constructing costs to build your asset. All of those are part of basis. In other words, they build into the cost, and by basis, it means the basic cost of an asset. Okay. Demolition costs. Now, this is one of the things that most people don't ever think of as being part of basis. But what happens if there was a previous structure on the property? Okay. You may have to destroy whatever was there and remove it before you can develop property. This happens a lot of times when there's an old building on the property. You have to clear off the old property and build up the new one. So there are demolition costs. Sometimes they're kind of spectacular when you blow up a building and have it fall. So, you know, I mean, if anybody's ever actually seen a building fall, I saw one fall once in Chicago. Okay, that was pretty impressive. You know, it's this big cloud and you watch the building kind of cave in on itself. I gotta say, I'd never, thought I'd see one, but they had the whole area cordoned off and it was on the news. They collapsed one of the old buildings in Chicago. And I was pretty impressed watching that thing fall. It actually does just kind of cave in. And then they have to start sorting through the rubble and pull it off truckload by truckload, hauling it off. But there's a lot of cost, it turns out, for demolition costs. And there's even some really impressive costs if there were things like the EPA gets involved. And there may be environmental issues about a property that they show up after you start to demolition the property, that you really have to do your due diligence. That's one of the pre-testing costs that most people don't know about. If you have not done your due diligence for a property, you could end up with some really serious costs to clean up a property. Turns out there are some properties that were older factories. Well, remember, a lot of the safety guidelines that we now have to adhere to were not in place years ago. And you might discover that the property was used for other things before. And even though it doesn't look like it now, it may have been used for, who knows. Anybody know what a car junkyard is? What an old, car salvage yard is, where they put all the old cars and they strip parts off of them over time. There's a place up in Clark County. It's now a mobile home park. It's an older mobile home park, and they have older single wides on them. Well, it turns out that before that, it was a car junkyard. Okay. It actually had older cars on it. And as a result, it, hang on a sec here. We're not able to do that. So as a result, the junkyard, those old vehicles had leaked transmission oil, gasoline, chemicals all over the property for years. Okay. They seeped into the ground and were in part of the topsoil. that property is now on a piece of prime commercial real estate. So it has been looked at to be purchased for a number of years. Unfortunately, it turns out that even though it is a prime piece of real estate, it is not valued high enough to cover the costs that it would take, that the EPA has deemed it must be cleaned up before it can be used for anything else. Okay, they will not allow it to be developed until the property has been cleaned up. That it is estimated it would cost several $1 million to clean up the environmental impact for that property. Just to actually literally take out all of the topsoil and all that has been over the original years from what was there years ago. It's not even that now. It's now mobile home park they were looking at. It's an old single wide mobile home park they were looking about taking out the park and putting in a large commercial development. And they're not able to do it because there are huge demolition costs. The cost just to bring it up to usable level would cost more than the value of the property itself.
Mm.
So those are huge costs. So sometimes the demolition costs are so large that it does not make it worth actually doing the repairs on a piece of property. All right. Now, next major thing. Remember what I was talking about is there's a big difference between repairs and improvements. When I was saying about building the property, those are improvements. Okay, they're actually adding to the basis of a property. Repairs to a property are things that are ongoing, that are normal maintenance, normal things that must be done to a property to maintain it. Okay, what would you say would be, just from you guys, how would you define a regular repair versus an improvement?
A repair is deductible, and improvement goes on to your basis.
That's true. That's very true. But how would
and
you
a
look
repair
at
is like,
how would you look at them difference-wise? I mean, what would you say would be an improvement versus a regular repair?
an improvement is like putting a deck on your backyard, and a repair is getting a new water heater.
There you go. That's a perfect example. Okay. There is.
Repairs keeps the property in working condition,
There you go.
while improvement add value.
Add value to the property. There you go. That's actually one of the perfect definitions. Now, there is a type of improvement. It's also known as rehabilitation costs. Okay. When you have a property that is a downtrodden property, improvements can be made which add value to the property. That's what we're looking at. When it actually does things, if you go into a property and you look at the property and it has been partially destroyed, things like this, if it just is a paint, if it's just, it needs to have some paint and things like that, that doesn't necessarily improve the value. Okay, that's just regular maintenance. Maybe its roof needs to have some repairs done on it, that sort of thing. If you are going into it, and let's say you do all of the landscaping, all of the, you take out all the existing landscaping, do all the landscaping, put in new decking. These are actual improvements. It didn't have decking before. The kitchen itself, if you just basically paint the cabinets, that would be one thing. If you actually remove the whole kitchen, put in all new cabinets, all new appliances, those are improvements. You are upgrading all the appliances. You are not doing just repairs. You are improving the value of the property. Okay, those are considered rehabilitation costs. All right. Now, improvements also can be things which add to the property, in other words, building wise. Like, let's say you are putting in a factory and you build a second factory on the property. Okay, or you expand the existing one. It started out as a 10,000 square foot factory, 10,000 square foot, I shouldn't, maybe 100,000 square foot factory, and you expanded it up to 200,000 square feet. Okay, it was a big warehouse, and you expanded it up. That would be a major improvement. Okay. Improvements are shown as significant increases in the value of a property. Okay, and that's the actual biggest difference between a regular repair and an improvement. Now, repairs, typically you're just replacing, and the easiest way to look at it is if you have an existing item and you're replacing it with a like item. Okay, so the water heater, like you said, goes out. You replace it with a water heater. Okay, you're not making a significant improvement to the property. If, however, the water heater was going out, so instead what you did was you decided, okay, I'm going to make this a greenhouse, and what I'm going to do is I'm going to go from this water heater to solar panel powered tankless water heaters, and I'm going to put chain 3 of them together, all powered by solar panels. I'm going to make it so I can take it off grid from whatever. So this is now considered a green certified house, and all this, I'm going to make this change because of it. That would be an improvement. Okay. You aren't just replacing a water heater. You're now improving the efficiency of the house, the value of the house. You're basically saving future energy costs. You're improving the fact that it's now a green certified house, that sort of thing. Okay, that's a major shift. All right, that would be an improvement versus a repair. So the water heater was a great example, by the way, Lisa. Thank you. So that is one of the major differences between a repair and improvement. Does it add significant value to the house? Okay. Other things that you think would be an improvement versus a repair? Now remember, it doesn't have to just be property too, by the way. It can be to your equipment. There can be a major software upgrade. Now, when we think about things, we think about our personal computers. Okay. We think about the one computer we have, and when we're going to buy software, we're going to spend that. If we think we spent $150 for the new version of Windows, that's a major thing, right? In a sense, but it took a lot to do that. What happens to the company that has 20,000, 30,000 employees, and they instead do a major upgrade to all new computer systems with all new operating systems? Would that be like a major improvement?
Yes.
Yes, it would. That wouldn't be just a repair. That would be a major improvement. So it doesn't have to be to the building itself. It can be to things within the building. Okay. Maybe their fleet they have trucks. Okay, they're a delivery company. Maybe they have a bunch of older trucks that they've been using. They have the regular panel trucks, and they've been added for a number of years, and they've done very well. And they decide to make a major investment into a whole bunch of semis and move in that direction. Okay, and improve the whole value of the company. Would that be an improvement?
Yes.
Okay. Yes, it would. Because you're making a significant change in the value of the company as a result of it. Okay. So Here's a major thing to consider. These are the IRS tangible property regulations. Okay. It took, they had temporary regulations that they had put in there in regards to the improvement of a property. Okay, they had a bunch of them. And then finally on January 1st of 2014, they passed the final tangible property regulations. Okay, and you'll want to know that it took effect January 1st, 2014. The IRS is still issuing guidance for them, but it finally took effect in 2014. And in truth, the regulations are hundreds of pages long. They are an issuance of regulations which stipulate what has to occur for property to be considered improved. So in other words, they have to see certain things for it to be considered improved. Now, if you can show, like we were talking about, that's why I asked you a simple question. Does that sound like an improvement? Okay. A lot of people have tried to get away with claiming things were improvements, and they were not really necessarily an improvement. It may have increased the value a little bit of the property, but it really wasn't an improvement. Okay, so an improvement is classified as a cost involving the betterment of a property. So in other words, it made the property much better than it was, significantly better. It was the restoration of a property. So in other words, it was something that restored it from a non-usable property into a usable property. That one's a big one because a lot of times there are condemned properties which get restored to a usable level. And finally, the adaption of a property to a new or different use. This happens a lot of times when you have like a warehouse. It was a condemned, more or less an unusable warehouse. They go in there, they clean the whole warehouse up, they put up the walls, and they turn it into one of the new high-end office buildings. Seen any of those? All over Portland, like, you know, the waterfront business parks. You know, they're all
Yeah.
over Portland. They started as old warehouses, and then what they did was they went into them, put some 3/4 height walls between the offices, and turned them into all new age office buildings. Sometimes shared office areas. Okay, they were adapted to a new use. They went from being an old warehouse. They actually scrubbed all the concrete floors. Then put new surface finishes over them, turned them into polished floors, put in industrial designed furniture so that it looked like it fit with the theme, took the freight elevators and turned them into basically now working elevators for staff, and all of a sudden they went from a industrial warehouse to an industrial themed office building. Okay, it was adapted to a different use. That was a major improvement. Okay, that would be an adaption. Can you think of any other ones? What's another one like that one? Got an idea?
Changing an office building into a hotel.
There you go. That's another one. I can think of another major one that happens now all the time, especially in Vancouver. Anybody know where Officers Row is?
No,
Don't know where Officers Row is?
no, because I don't go to Vancouver.
Officers Row is one of the most famous buildings in the entire country. Officers Row is part of Fort Vancouver. Does anybody know the history of Vancouver, by the way?
I've been there because I've been there for fireworks a couple times.
There you go. You know where Esther Short Park is then. Most people don't realize this, but Vancouver is actually Fort Vancouver. Okay. Fort Vancouver is the first built building in the United States west of the Mississippi. Okay, most people don't have a clue about that. It's long before Vancouver, BC, by the way. Vancouver, British Columbia, much younger than Vancouver, Washington. Vancouver, Washington is the first building that was built in the entire United States west of the Mississippi, Fort Vancouver. That's why the Lewis and Clark Trail ends here. Okay, so guess what they built at Fort Vancouver? Naturally, that's why it's called Fort Vancouver. They built the fort. It's still there. They've restored it over the years. They built it up. The original fort had the officers' buildings, the original housing, the barracks, all that have all been built over the years, and they're all still standing. Well, most of them have been, they've all been rebuilt over the years. Well, for a very old fort, because by the way, the original fort is still, is National Historic Building, is still out there. It's where the Pearson Airfield is. It's right off the side of the airfield is the original fort. And it actually has, you know, the wooden spikes standing up kind of thing. That's how the original fort was built. Okay. Well, it's still out there. It's considered actually a national military monument. And most people, when you say Vancouver, they go, oh, you're in Canada? No, much older than Vancouver, BC. And that really shocks them when you discover that it's much older than Vancouver. Actually, the person who did Fort Vancouver actually then went up to Vancouver, BC and did it. So, up there in the original buildings, now we have to understand this. These are officers. They've been up there for a very long time. So these are really old buildings, really cool buildings, all basically handmade buildings, not the kind of things that were put out with, you know, power tools and whatnot. These are basically hand carved with hand tools. Okay. So you have a whole bunch of these buildings in along a road, which was originally just basically a trail, that is now Evergreen Boulevard. Okay, right up the middle of it, there's a great big park there. What would you do with those buildings that have no value because you can't use them as a military base anymore because, well, they're not usable as a military base? So what did the government do?
Made them into museums.
Nope. Sold them off. You know what the developers did? Turned them into high-end businesses. Really high-end businesses. It's called Officers Row. Very high-end businesses, real estate firm, Windermere has an office there. There's some very high-end restaurants along there. Shops, things like that, all in the old buildings. Okay. Very bad parking, however. Parking is on the one side, but actually all of them have reserved parking behind the buildings. So you can actually go back behind them because they didn't have cars when the buildings were first made, by the way. So they didn't worry about cars during construction of those buildings. So they parked behind them. Very high-end reservation kind of restaurants. Okay. Very new age ones. All along there. So all of those old military buildings were converted into high-end businesses. All really nice buildings. Really nice buildings. Kind you walk up on the porch. Has all the hand-carved planks for the boards. They've all been updated, you know, and they've all been redone because remember they didn't have power originally to start, and they certainly didn't have elevators and that sort of thing. They don't now. They've got all stairs and all. And they didn't have power for the lighting, so they had actual old oil lamps originally. So they pulled that out, and then it went to the gas lamps, and they pulled those out, and then it went to electricity. So yeah, old buildings converted into high-end offices. all along Mill Plain, because it's a very old town. Like I said, very old town. Some of the oldest ones in the country. So that's what happened to a lot of them. Old homes, especially along Mill Plain, old homes, because Mill Plain is now a major street, in other words, a major business street. Does it make any sense to have houses along a major business street? No.
No.
So what they do is instead they adapt them. They adapt them to private businesses, doctors' offices, things like that. So that's what has happened to a lot of them. So that is the adaption of a property, where it goes from one use to another use. And that's really important because those are the guidelines that the IRS set for the actual regulations in 2014, because people were trying to say, well, this is an improvement to the property. They'd put paint on it. No, not exactly an improvement to the property. It had to make it a betterment of a property where it was actually a significant improvement to the property. It had to restore a property, or it had to be an adaptation of the property to a newer, different use. Okay.
Okay, so I know that if you just replace a few shingles, that's a repair, and you replace the whole roof, that's an improvement. So if you replace all the siding in the house, that's an improvement, right?
It has to be something basically structural. If you want to think about it in real estate terms, it has to be something structural to improve the house. So all new siding on a house would typically be something, especially because you're normally going from something like older older style, sometimes who knows what type of siding, to something like, who knows, vinyl siding, or something with a longer life. Most
Yeah,
people
extend
say,
the life.
hardy plank, to hardy plank, something like that. So yes, that would be an improvement. A lot of times you could put something on it, it all depends on who you are, if you think it is, but one of the major improvements is if you go to a regular composite roof to a metal roof, which has, a 30-year life on it. So, and if you actually have the cedar shake roof, which if it's actually oiled has actually technically a 50-year life, but you actually have to oil it each year, every other year. Most people don't, so the roof ends up drying out too much and cracking and splitting. But if you actually do have it oiled every 2 years or every 3 years, I can't remember what it is, a cedar shake roof is actually the longest lasting roof there is. So, but yeah, that would be an improvement then.
I need to get all new.
So, well, and each one is a matter of price too. The all metal roof is actually a great improvement. Some people say they hate it. They think, it looks like a shed. Well, they actually have metal roofs now that actually look like shingles because people were complaining about the way it looked. Well, you can form metal into almost any shape you want. So they have them now that interlock and they look like regular shingled roofs, but they are metal. It's kind of like how you do hardy plank. Most people don't realize hardy plank has very little wood actually in it. Hardy plank is actually concrete. It's a combination of concrete, epoxy, and wood. So that's, by James Hardy. It's ironically enough that it's hardy plank. So, but those would be an improvement. Okay, even though it looks like wood, because they form it to look like wood. Okay, it's poured into a mold that makes it look like it's actually wood, but it's not. So, but they can do that with metal too. They can actually shape it so it looks like it's a shingled roof, but it's actually metal. It's kind of like, anybody have a Surface Pro? I have a Surface Pro.
My son has one. I want one.
What's really cool about the keyboard, that you can pull off and put on it. Kind of feels like cloth, doesn't it? It's kind of like it's a neat keyboard. Where's my keyboard? All my keyboard's in the other room. But anyways, it feels like cloth, okay? Microsoft developed the technology to build it, okay? Looks like it's cloth, feels like it's cloth, you know, it's kind of like a furry kind of surface, soft. There's nothing cloth in it, it's plastic, okay? It's a modified plastic that they have for the surface of it, the way they actually pour it and form it, that it actually turns into, it's very tough and it's a hardened plastic. You do the same things now with just about anything. So Microsoft developed the technique for doing it so they can make it into their keyboards. It's a great way to do it. Doesn't feel anything like it's actually plastic. So, all right. Now, these are really important. These are the safe harbor rules. Okay? Safe harbor rules apply to how and what you charge the cost to. Okay, I'll tell you what, we'll do this. It's 11:30 now. Let's take a 15-minute break quick because I gotta get something to drink because my throat is starting to fail me. Let's take 15 minutes and we'll come right back to it.
Okay.
Okay, sound good? All right.
Yeah.
Not hanging up this time.
No, don't. All right, let's make sure we got everything going here. Get that going, that going. Okay. The safe harbor rules. All right, now who's calling me? All right. As you can tell, the rules for what is basis, what is an improvement, what is deductible. Why would you want it to be deductible versus a basis? What's the main reason?
Save money on your taxes?
There you go. Because with basis, you don't get to recover it until you sell the property, okay? Or you've got to deduct it over time, okay? Because that's one of the things you get to do over time to recover those expenses. But if it's actually just a regular repair, you get to deduct that year. So it's a major thing you'd want to do. You want to be able to deduct it. Well, there are a set of rules that were established called the safe harbor rules. Okay, these were established to set up what would be considered an actual deductible maintenance cost, or what would be required to be turned as part of the basis of a property. Now, if it's a basis of a property, you're not going to be able to put that on your taxes. Okay, that's not so good because you want to be able to deduct it. That's going to cut down on your yearly income so you can not have to pay taxes on that. Well, the IRS said a lot of people were counting things as maintenance when it should have been part of the expenditures for the actual cost of a property or improvements. So they established the safe harbor rules, and they established a couple of basic rules so that you could determine where things fell, and you could decide if it was considered a maintenance cost or an improvement. So here's what they did. They have the safe harbor rule number one. Safe harbor rule number one says businesses with an applicable financial statement. So in other words, a financial statement which says these are things we count as expenses, these are things that we count as maintenance, that you have a financial statement and you are related to it. In other words, You can specifically show that these are normally related to your cost of doing businesses. Like if you are an investment company, a real estate company, and you have property maintenance all the time, those are regular maintenance costs. You would show that the things that are being done are regular maintenance to your properties. If it is something where you have a factory and you are buying new equipment, you can't just show that that was maintenance for the facility. You have to show that it was a capital investment, and then that has to be depreciated over time. Okay, so if it is something related to your day-to-day business and you can show it as maintenance and show that you do it on a regular basis, this is a financial statement indicating that you buy these on a regular basis, that you do this on a regular basis. That is how you establish it as maintenance and not a capital investment. If that happens, then you can show that any invoice or per invoice or item, you can do up to $5,000. This is important, up to $5,000 per invoice or item, as long as it has a written capitalization policy. In other words, what you capitalize, you have to have a written policy as to showing what you consider capitalization expenses versus regular maintenance expenses. You can do up to $5,000 per invoice or item, or show that it has an economic life of 12 months or less. Now, it's really important, because if the item has an actual life of an expected life of 12 months or less, then it's considered usable in that year, and that you're going to use it to be used up in that time frame. Now, that would be things like a large purchase of materials, supplies, paper, who knows what it may be. Let's say you have a $5,000 invoice of paper. You're going to use up paper. We use up lots of paper. Toner, especially. There you go, printer toner. I had a huge order for toner this year. They had to approve it and had to go through because of we were all buying the same type of toner. So when I placed it, it was way over our normal amounts. We had to place the order because we needed it. It was usable within 1 year. So as a result, it was considered a safe harbor expense. It wasn't like some improvement. Okay, items like that which will be used within 1 year, within 12 months or less, fall under safe harbor rule number 1. Safe harbor rule number 2 says that if you do not have the actual plan in place saying what is considered a capital expense, what is your regular expenditures, would this be something that you would be using on a regular basis? Like in our case, we would show toner and paper and things like this as our normal expense, and some desk furniture, things like that as our normal yearly maintenance. If we instead were to show them that we bought something out of the ordinary, if we don't have that plan in place, we could only do, instead of up to $5,000, we can only do up to $2,500 per invoice or item. Okay, that's the amount we were permitted to deduct on any single invoice, is up to $2,500 or per item. Okay, and those are really important, because those dollar amounts, if we go over those amounts, they're going to start questioning, is it a capital expense? Okay, so third rule is small taxpayer safe harbor for real property. If a taxpayer has gross receipts of $10 million or less, okay, and that's an important thing, because most people, really, $10 million or less, you think that's an exorbitant number. It's not for small businesses. Okay, small businesses often have over $10 million in overall expenditures. But if you're small enough that you're $10 million or less, and you are dealing with real property. Now, a lot of these are the places that build small homes, that, contractors, property maintenance companies, things like this. Okay. If you have $10 million or less, they can expense all repairs rather than capitalize them as improvements. So in other words, you want to expense them as repairs, because then you can deduct them all in the first year. You don't have to capitalize them as an improvement. Okay, that's an important difference. If you have to capitalize it as an improvement, what's the depreciation time on real property? You know me. How many? If you had to depreciate real property,
39.
You got it. That's a lot of years to depreciate real property. That's a lot of years to recover capital investment in a property. So you're pretty much not going to get that money back off your taxes. But if you can show it's a regular expense, that's great. You get to actually deduct it that year. So you want them to be deductible expenses. You don't want them to be capital expense. Okay. So if it is improvements with amounts less than $10,000 or 2% of the unadjusted basis of a building property. So look at the basis of the property. If it costs you, say, $200,000, 2% is $4,000. Okay. So if you consider that the rule, right, 2% of the unadjusted basis of a building property, or $10,000, whichever is the lesser. Okay. Then they can consider it as an expense instead of as an improvement, because they don't want to have to deduct that over the full length of the property. They want to take it that year. Okay. Because if you, let's say you're doing the kitchen, okay, you're improving the kitchen, you want to take that as an expense because you want to deduct that year, especially if you're doing a rental property. Do you want to expense it over the next 39 years? I certainly don't. I would definitely want to do it over that current year. I don't want to expense it over 39 years. Okay, so if you're dealing with real property, it is based on if you have $10 million or less in gross receipts, it is any expenditure that is either $10,000 or 2% of the unadjusted basis of a building property, okay, which is really important, that it can be considered an expense and not as a capital improvement. All right, and these are the safe harbor rules. All right, let's get to the next one. Routine maintenance. Now this one is really, really basic, okay? Routine maintenance is a safe harbor rule. If it is something, it allows for the deduction of routine maintenance costs that are required more than once within a 10-year period for buildings, or more than once within the applicable class life for non-building properties. So in other words, how often do you have to paint a property usually? And when you think about it in real estate terms, how often do you usually have to paint a house, paint a building? About every 5 to 10 years, something like that. A little bit longer in some cases, but usually about every 5 to 10 years, you kind of have to paint the outside or at least fix it up a little bit. How often do you have to do a roof?
15.
About every 15 years. Okay, that's the life expectancy of a roof. So usually and that's the real expectancy. So you're probably doing it about every 10 years. something like that. Okay, some people go a lot longer than 15 years, by the way.
Yeah, well, no,
Yeah,
we're at 10.
yeah, they end up letting it go, and they let it go a lot longer than that and never do anything on the roof. Big mistake, because then it ends up costing a lot more than it would have cost them, because if you're just replacing the top shingles on a roof, that may cost you $1,000 if you got lucky, and actually did it on time. Maybe it cost you, who knows? The materials, time, you got a couple of guys who can do it fairly cheap. Not a bad thing. If you have to actually, as a result of not doing it, have to replace the whole roof, you are talking about a bunch of work. If you have to replace those trusses, you're talking maybe $10,000 or more. Okay, so
Yeah, we were lazy and we haven't. We need to oh gosh, now I can't think of the word. The siding. We have to do the siding, and it's going to cost us like $12,000 because we got lazy and it's
didn't
horrible.
paint it, didn't bother with it. Most people don't, they don't paint it, they just let it go. And next thing you know, it starts to chip. You don't pay attention to it, so it chips a little bit more. Water starts getting behind it. Oh, it's a pain. All because you let it go. So,
Yeah, we know.
so routine maintenance is really important, and it allows the deduction of routine maintenance. Now, this is things that occur more than once within a 10-year period for buildings, or more than once within the applicable class life for non-building properties. In other words, depending upon, like, if you have stucco siding, if you have, if you have cedar shake, if you have cedar siding on the side of your house, whatever the expected life is on it, and you're putting it on there, and replacing it, it's important. But if it's happening within a 10-year period or within the expected life of it, so maybe it has to be replaced, maybe whatever you do on this particular thing, it only has a 5-year life on it, and you're doing it twice, or once every 5 years. Guess what? That's routine maintenance. Okay, that is not an actual improvement, and that is great for you. I hate to tell you, that is great for you. You do not want it to be part of your basis. You want it to be part of your deductible expenses, because you do not want to deduct it over the next 39 years. Okay. So then finally, the $200 de minimis election for materials and supplies. This is the things like your staples, your pens. If something of a unit of property that costs $200 or less, okay, they don't expect you to expense it out, to make it actually a capital expense. Okay, they will understand that it's a regular usable item. If it has a useful life of 12 months or less, if it's spare parts acquired to maintain or repair a unit of property. So if you're buying spark plugs for the tractor, all right, they understand that. Okay, it's parts for this other thing. Maybe it's maybe it has to be, you're spending $180 on a water pump because the tractor's water pump's gone out and you have to spend it on it. It's a part for it. Okay, no problem. Maybe it's tires you're buying up. Not a big deal. All right. Now, the incidental materials that are used as part of business, like pens, paper, staplers, trash baskets, toner, anything like that, they get counted into this category. These are items that you need to buy on a regular basis that have to be purchased for business. Okay, and as a result, they don't count as a capital expense. You need to buy them all the time. Okay. The IRS knows that. The IRS isn't expecting you to make it a capital expenditure. All right. Now, other changes. Now, this is important. other changes to the basis of a business property. In other words, what happens when you have a piece of property and something from the outside happens? Okay, what does that mean? What could happen from the outside which would change my house?
Casualty.
Not. I'm thinking more like to improve my house. What if I live out in the country?
I didn't hear the question because my dogs were barking.
What are changes that can happen that positively impact my house, usually to improve my property that I have no control over? That are going to affect the value of my house.
Road improvements.
There you go.
Sidewalks.
Now she's getting it. Now she's getting it.
What'd you say?
Okay. These are things that happen that you don't control. But the government comes in and they change the value of your property because they just put in the sewer line. Okay. They just brought water to your property. You're not a well anymore. Okay. You're now on a water line. Cable just came in. Cool. I just got cable. Okay. I got high-speed internet. All right. They just did the improvements. They just ran FiOS, you know, the fiber optic to the house. Awesome. I didn't have any control over it, but it happened. Okay. That improves it. Now, what about the other side of this? What drops the value that I have no control over?
Yeah, what I said, casualty.
Casualty, but also
Theft losses.
But there's another thing that the government can do.
Uh,
What happens when they put in that road?
It takes away from your property.
It takes away from your property. You can actually take away the size of your property. Okay, so what happens when they take that chunk of your property? Does it drop the value of the remaining property? That drops, you know, the value that's left changes. You get money out of it. You know, they give you this money. That's basically income to you. What does that do to the basis of your property? It changes it.
Reduce.
It reduces it. That's right. It reduces the basis on what's left. Okay, so they've bought a piece of your property. It reduces the actual basis of your remaining property. Okay, what happens when they actually change the zoning of a property? Okay, you think it's going to be positive. What happens if it becomes industrial? The main
Then
zoning.
your rental house is no longer a rental house.
Yeah, well, it's grandfathered in usually, but what happens if they try to, if they want to make a change to the property? They usually can't do much of a change, can they?
They put a whole bunch of office buildings around your really nice house. It lowers the value of your house.
There you go. There you go. It lowers the value of the house, all because of things that were affecting it. Now, what happens when they put in that sewer line? All
Increase.
right. It'll typically increase it, but what happens when they assess that to you? Remember, if you get an assessment.
So with business property, you can't deduct that part of the tax, right?
That's correct. You can't deduct assessment on taxes. You can deduct charges for the maintenance and repairs, but you cannot deduct assessments. So they have to be included into the cost value of a property. So when it ends up, they get an assessment and you end up having to pay the assessment, that's part of your basis value. That's not an expenditure. So that's not a deductible expense. So let's say they just put in a sewer line into your property or buy your property and they assessed you $10,000 to put it in. Can you deduct that?
No.
You can't deduct that. You have to add it to $10,000 to the basis of your business property.
Mm.
It has to go on to the depreciation of your property. You can't just deduct it as a cost. That's what sucks, because it goes with the property then. So that $10,000 you just spent that you wanted to deduct, you can't deduct. It has to be depreciated. Okay? You wanted to deduct it, but you can't. It has to be depreciated. Okay? Kind of sucks with that, doesn't it? You cannot depreciate special assessments. I mean, you cannot deduct special assessments. You have to include it in the basis of a property.
I actually remembered. Yay!
She did good. Way to go, Lisa. And that's one of those really just it's like it's a bad thing really when you think about it, that you want to be able to deduct an expense, deduct it as an expense, because it came out of your pocket, didn't it? Are they going to give you 39 years to pay for it?
I don't think so.
Nope. They're not going to give you 39 years to pay for it. But how long does it take for you to get to recover it? 39 years. Because that's how long it takes you to actually depreciate it.
Mm.
Doesn't that suck? It takes you 39 years to recover it in your expenses, more or less, through the depreciation. But you don't get you don't have 39 years to pay for it. County's going to charge you it within 10 years or whatever, 5 years, 10 years, whatever the assessment is. Doesn't that suck?
Yeah.
So think about that. Other things can affect your basis value of your property that you have no control over whatsoever. Now here's the one that you were talking about: casualty and theft losses of business property. Now what exactly does that mean? Ideas?
Casualty could be like a roof falling in, and theft can be stuff they stole, like the copper piping and stuff.
There you go. That's very possible. So things that happen: theft may involve taking money or property by blackmail, burglary, embezzlement, extortion, kidnapping for ransom, larceny, and robbery. The taking of property must be illegal under the state law where it happened, and it must have been done with criminal intent. Okay, that's the actual rule for it. So casualty is when things happen where you get property destroyed. So if something rains, roof gets destroyed, damaged, what does it do to the value of a property? Destroys the property.
It decreases.
Decreases it. Okay. It'll wipe out it can wipe out the value of a property almost entirely, depending upon how much damage is done. If there's a fire, think about what a fire does. Okay, and if you don't have, what happens if your hazard insurance had lapsed?
Oh man, you're in trouble.
Okay, your hazard insurance had lapsed and the building catches fire. That's not a good thing. And if you had a loan on the property, the bank's not about to let that happen. Okay, it's kind of like letting your car insurance lapse while you have a loan on a car. Your loan company will typically not let it lapse. That's why they say they want a binder that they get notified if your insurance lapses. So, not a good thing, huh? Well,
I even had to have a binder when I was doing real estate. on my auto insurance with the broker.
Insurance with the broker, correct? Saying that anybody in your car, because you're carrying possible clients, and your broker wants to make sure that you're covered, that the insurance company is aware that you may be carrying clients in your vehicle. Because some of them won't carry people that are not of a friend or family nature, that you're carrying them for a business nature. So they want to know that. So when they ask you what were you doing and where were you going, and you try to explain to them, well, I was driving to show this house. You were what? So you were actually at work doing it. So it falls under quite possibly the broker's insurance policy is what they would want to say, because you were acting under the business, under the intent of working for the business. So they want to try to put it under the broker's privy. So, all right. So losses from casualty and theft. If it is personal property, let's say something happens, there's a fire. Let's talk about the deductible. When something happens and there is a loss, okay, let's say there was a fire in a house and I'm working here and I have something happened and it destroys like $5,000 in my personal property. The first $100, okay, is immediately a reduction, because I can. This is to deduct it, as a casualty, as a loss. The first $100 must be reduced on all personal property. But in addition to my personal property, I have my work laptop here. Work items do not have that $100. Business items do not have that $100 deductible. It's $100 that it's a reduction. Loss must be reduced by $100 on personal items, but not on business items. And Thomas, I can deduct the portion in a loss. I can deduct a portion that exceeds 10% of my AGI. So my adjusted gross income, if I had a loss, a massive loss for whatever reason, and if my adjusted gross income is, say, $20,000, okay, and I had a $5,000 loss, so 10% of $20,000 is $2,000. So everything above that $2,000 I can deduct. Okay, so I take that $2,000 off of the $5,000, so I have $3,000 I can deduct. Of those personal items, though, I have to take $100 off. I have to reduce it by $100 because it's personal items. So I can deduct $2,900. Okay. Now, if those were business items, I could do the exact same thing, except I don't have to take the $100 off.
So what kind of business items? I'm a little confused.
If they are items that are owned as business assets, if they are my personal items, like if it's my couch, my TV, my stereo, those are my personal loss. Okay. Those I have to absorb the cost. I have to take that $100 reduction. If it's, say, my business laptop, let's say I'm a sole proprietor and I use this business, or I'm a real estate agent. Okay. I'm a real estate agent and I use this computer for work. I don't have to take that $100 off of it. Okay. That's the difference.
Okay. So like if an office building burnt down, all the the couches and stuff like that would be considered a business property?
That would be considered a business property. They're owned by the business. However, your personal items within the building, let's say you had your purse there, your personal laptop and that, that was lost in the fire as well. Okay. You would be able to suffer a loss, but $100 of that you have to eat.
Okay, I understand.
Okay. That's what I'm saying. You have $100 that you have to eat off the top of it because it's a personal item.
You can recover only $100.
No, you can recover everything over $100. The first
On your
$100
personal item?
on your personal items.
Okay.
Those are a casualty because you can recover your personal items off your taxes if you suffered a loss. Okay.
But personal now, it's only if it's in a it's in a disaster area.
If it's in a disaster area or something of that nature. What I would suggest you guys do is one of those two documents I sent you is the casualty and loss document. It's really complicated to try to explain it. It's probably best if you read through that once because that's specifically casualty and theft loss. Okay. That's what I'm saying. I wouldn't worry so much about the personal business side. I'd be worried more about the business property side. Okay. So read through that one once. It's only about, I think, like actually 17 pages of reading, something like that.
Let's put all these on my tablet and read them that way.
And just read them that way, yeah, because it's only, I think, like actually 17 pages. It's a little bit longer than that, but I think most of those are just indexes and that sort of thing. Now, when you do get money back from it, like if there is a loss, remember, if there's a fire or if there's something that happens, how you calculate what your adjusted basis in the property is. It's whatever the original basis is, okay? Then off of that, you subtract whatever the salvage value is. Okay, so you're trying to calculate what the basis is, right? So you can recover that. Off of that, you take anything that was a salvage value. So if something was like you're in a car accident, remember, even though the car was totaled, it still has a value. Okay, even though the car was totaled to you, it's sellable for salvage, for parts and for things like that. So it's sold for a few $100 no matter what.
Yeah.
Okay, so it still has salvage value.
Yes.
And then that is minus any other, any insurance or any other reimbursements you got. Okay, so your actual basis value now is that minus those two things. Okay, and that'll give you its new basis value. Okay, because you got that out of it, right? The salvage value, they gave you some money for it. The insurance value, they gave you some money for it. So you're taking that basically out of the property. All right. Now, this one is a little bit different. Have you guys ever dealt with stocks?
Yes.
Okay. Stocks are, you are buying a piece of a business. Okay, that's what you're actually doing. You're buying a share of a business. That's why it's called a share. Okay. When you do it, there is the basis value of the stock, and lots of people own stocks. So you have to be able to calculate the basis. Remember, I told you basis is really simple. Basis is just how much you paid for it. When you talk about the basis, how much would it be for a security, a stock? It's the cost of the stock plus the cost that it took for you to buy that stock. So in other words, the broker's fees, any trading fees, anything like that that it took to purchase that stock. That's the basis. But as you know, stock does strange things. It has kind of a life of its own. A stock can split. So what happens to the basis cost of each one? If a stock is this and you paid $100 for it, now it splits into two of these. How much did each of these stocks cost you?
It's now $50 each.
There you go. So what happens is if it started as $100, if they split, each one of these costs you $50 to get. No matter what their value is, dollar-wise, if it says, the stock is now a $300 stock, whatever its basis is how much it costs you to originally buy them. And together, it was $100. When they split, a stock actually is dividing in two. So as it splits, it went from $100 to buy it to two $50 stocks to buy it. Okay, so when a stock splits, it may be now, if each of these split, okay, how much is your basis in each stock if each of these split, these $50 ones?
$25.
$25, okay. Each one has a life of its own. All right, and each one has a basis. Now it's based on what you originally paid for it, and as they split, it divides just like that. Just however many times it splits, that's how many times you divide the original amount for, and that's how much each one is based on. So when you get when you purchase a stock, your basis is initially, though, when you're trying to figure out what the basis amount is, it is the full purchase price, including all of the broker's fees and all the fees associated with it to get it. Okay, is that pretty clear? Because that's really all there is to securities. There's nothing,
Yeah.
It's not too hard. It's if it's a $50 share and it costs you $2 to buy it, what's the basis of that share?
7.
$52.
I have 52.
Oh, okay.
Because it cost you $50 to buy it
Yeah,
and
you're wrong.
$2 in fees. It's $52. Okay. So if you have a share that you bought, it costs you $180 as the cost of the share, and your trading fee was $6. It was $180 for the share, and your trading fee was $6. What is your basis for this stock?
186.
186. It splits. What's your basis for each one?
93.
93. There you go. All right. Taken and divided by 2. 186, that's what it cost you originally. They split, it's $93. That's all there is to securities basis. It's not hard. It's just whatever expense that went along with the original cost. Doesn't matter what the original cost, what the original cost was. It's the total cost. It's just like buying a house. When you bought the house, what was the basis? The sales price plus all the fees plus the taxes plus the all put together. Okay, you put it all together, and what was your original basis? It may be 1.3 times or 1.03% of the or 103% of the total cost of the house when you got done. Okay.
Okay.
Because you have those fees that were associated with it when you first bought it. Okay. So all that is going into this first structure. When you think about it, it's the total cost. That's what the basis means. Total cost of a purchase. It can change over time if you add stuff to it, like a special assessment or capitalization. Here's this factory cost. It just cost you $10 million to build this factory. Okay. Well, it's going along just fine at $10 million. All right. Now, all of a sudden, you add another $2 million in new equipment. What's your basis? It was $10 million all along, but then you just add now $2 million in additional equipment. What is your basis?
$12
10
million?
million?
$12 million. Correct. Because you added $2 million more that would become part of the basis. You improved it by that amount. Okay, you improve the property by that, or the facility by that. All right. Now, do you understand that in regards to the basis itself? It's not just the original purchase price. It is the total cost to buy the property. When you buy a car, what goes into a car? You wanted to buy the car, so what do they have to put on the car? Sales tax. They put on there the plates on the car. Remember, they got to title it. They got to send it to the DMV and record it. They got to do all this, right? So the basis of the car, it cost you $8,000 is the sticker price. When you got done with everything, you walked out of there and it was going to be like $9,300 was your loan, and you're figuring out, why did it come to $9,300? You're going, because if I put that fee in there and I put that fee in there and I put that fee in there. Okay, so now I see what it is. So what would your basis for the car be? Would it be the $8,000 or the $9,300?
$9,300.
$9,300, because it's the total cost that it costs you to purchase that item. It's not just the initial price, it's all of the fees associated with it. Okay. And when you add something to it, like that special assessment, think about why you can't depreciate, or why you have to include a special assessment in the basis value of a property. Can you take it out? Can you just
No.
pull it off? You can't. If they've put in the sewer line, you can't just say no, can you?
No.
No.
Okay, so it's part of the property now. It's actually adhered to the property permanently. So what's that going to do to the value permanently? It's going to make it a little bit higher, hopefully. You know? So no matter what, your property just went from a place on a septic tank to, oh, now we're hooked up to the city water sewer system. So that was an improvement. So even if you didn't necessarily want to do it, you just got a permanent addition to your property, even though you didn't necessarily want to do it. Did you want to have that $10,000 assessment or something? I mean, be honest. Did you want to add $10,000 to your property?
No.
Probably not. Okay, especially if you're on septic, you don't really want to change your property over already. That's really only going to help the newer houses. It's not going to help the old houses, because you're not hooked up to the sewer line, but you just now had $10,000 assessment. Does it go with your property? Yes. No matter what, that's still going to be attached to your property. So that's why it has to go in with the property value.
Unless you've been fighting for the stoplight or the stop sign or the sidewalks.
Yes. Yes, there you go. So it puts it into your property. It adds value to your property, permanent value to your property. Okay. Basis other than cost. Okay. What does that mean? What do you receive that's basis other than cost? So when you're talking about where do other things can you have? Let's say I wanted to buy this house, right? And I'm trying to figure out how much it how much it cost me, and or this guy, I'm buying it, right? And I want to pay for it, but I don't have all the cash. But maybe I can do something else. I can trade him something for it.
Property, other property.
There you go. Maybe I can trade him another property for it. How about for services? How about things like this? Property received for services. So maybe I need to have something done. So I say that, hey, tell you what, I've got this TV or something. You fix this for me, I'll let you have this TV. What do we have to figure?
Fair market value.
Fair market value. There you go. It comes into play again because the fair market value for those services determines what the basis for those services were. What if I trade you instead? Let's go into things here like, how about in lieu of wages? So instead of getting paid, you say, hey, tell you what, you really want that motorcycle, kid? I'll let you have that motorcycle. What I want you to do is this. I need some landscaping work done. It's an old motorcycle I got in the barn. You can have it. I want some landscaping done. Okay, so you work for him, and in lieu of the wages, he gives you those
Property.
that property. Now he got landscaping done, right? So what's the
Yes.
value? What is the value that went into that landscaping? Because that landscaping on his property increased its value, didn't it?
Yes.
Okay, so it may have increased a lot. So think about it. So how much was that worth?
The fair market value.
How much did it cost him?
The motorcycle, the fair market value of the
There you go.
motorcycle.
The fair market value, and I knew one of you would get it. The fair market value of the motorcycle.
Yeah.
That's what it cost. The fair market value of the motorcycle. So hey, that's what they agreed on. So what's the fair market value of the motorcycle? Maybe it's $800. Who knows? But in the
I
end,
want
that's
to
the
redo my
basis.
whole landscaping for $800.
Wouldn't that be great? It's a kid looking to get that old motorcycle. Maybe the kid knows that if he fixes it up, it'll be worth more. Who knows? Okay, so he did all the guy's landscaping for him. It's the only way he could afford it. He didn't have any cash, didn't have a way to get it, so he did a bunch of landscaping. Cool. So property in lieu of wages. You can do that, and it makes it really great for you because maybe you can't get it any other way. So it's the fair market value of whatever you received goes against whatever you improved. Okay. Bargain purchases. Now this is really interesting. What happens when you trade stuff? Okay. When you discount it, bargain purchases.
Mhm.
What happens when you trade something? You trade it for less than its fair market value. What do you do with that? Is that part of the basis of buying it? See, think about it. Let's say that you just said that the landscaping. You went, wow, I can get it for $800. That'd be kind of cool, wouldn't it? The landscaping of all this for $800.
Yeah.
That'd be cool. Is that a fair trade necessarily?
No, not necessarily.
Not necessarily. So what about the difference in that? What does the kid have to do? Or what does the guy actually have to do who's landscaping he got additional basically income for in property? He's got to account for what?
Or the discount?
For the discount. That's additional income to him that,
Yeah.
I mean, his landscaping may be worth $10,000 now. Let's do it that way. Let's make it a little outlandish. Now that this kid did $800, got an $800 motorcycle for $10,000 worth of landscaping. That's a little bit of a difference, don't you think?
Yes.
Okay, so what happens when you have $800 worth of motorcycle for $10,000 worth of landscaping? There's about a $9,200 difference there that the guy with the landscaping got, right?
Mhm.
So what does he have to do with that? What is he supposed to do? Let's put it that way.
He's supposed to count it as income.
There you go. He's supposed to count it as $9,200 in income. Is he ever going to do that?
Hell no.
Hell no. Yeah. Yeah, but that's exactly what he's supposed to do, because if some kid did that was really nice, you really think he's going to count it as income? Probably not. Let's be honest. Let's not lie to ourselves here, okay? Hell no is the answer. Okay, he got a great deal. The kid worked it off, got the motorcycle he wanted. Awesome. But is that guy going to count that extra amount that he got in labor? You know, it's like, oh my God, do you know what value I just got? Kid did all this work for me. Oh, that's nice. So you're going to go, kid, you know, I got to put this $9,200 in additional value you gave me now on my taxes. Have a nice day. Think that's going to happen?
No.
Not a chance. Okay. So we know that to be the truth. We
But you're
know
supposed to.
you're supposed to. That's the key there. You're supposed to.
To testing.
For the testing portion of our thing. Yeah, you're supposed to include that in your income. So when it comes to the test, what are you going to do? In regards to the test, when they ask you that you have two things that are outrageously different in value, that one guy gives you something worth $800 for $10,000 worth of work. What are you guys gonna say is he supposed to do?
Yeah, the difference should be included in his income.
That's correct, and it's got to be included on his taxes as income. So remember, for testing purposes, what is the answer? He has to increase his things by his income by $9,200. Now, in reality, is he going to do that? Not a snowball's chance.
No.
Okay? There is no chance in hell this is going to happen. Okay, but is he supposed to do it?
Yes.
Yes. And when it comes to taking the test, is he going to do it? Yes.
Yes, he is.
Yes, he is. In regards to the test, yes, he is going to do it. Okay, he's going to be a very honest person, and he's going to include that extra $9,200 on his tax and pay the outrageous taxes on it. Okay? But is it going to happen in reality? Okay. So that's how you have to learn it, though. There is the test version and then the reality version. Okay?
Yes.
All right. Do you guys now understand basis a whole lot better?
Yes.
Basis is
Yeah.
not complicated at all. Basis is something, for some reason, it confuses people. People hate it. People I hate basis. I can't stand basis. Basis drives me nuts. I don't understand what it means, especially when they call it basis and it should just say total cost. Okay.
I did the basis and depreciation module on the Flex Force.
There you go. That's very good to do. So yes, because the next one we're covering on Wednesday is the next section, which is the depreciation and amortization, which is the other depressing part of this. Okay. You know, they put them in there because they sound really, you know, slow, long, difficult. They are not hard. I mean, face it. What is basis? Total cost that it cost me to buy something. Okay, to really buy something. What I want, because I can deduct maintenance costs. I do not want anything to be part of my basis. Why? Because I cannot get it back that year. I do not want anything to be part of my basis. I want my basis to be as small as possible because I cannot recover it that year. I cannot deduct it all. Okay, it's going to be depreciated. It's going to fall into the next chapter where I got to depreciate it through the end of time. Okay, I don't want to depreciate something through the end of time. I want to deduct it this year. Okay, I want to recover it right away. I want it to be a maintenance expense. All right, that's the difference. I want to take it off today. I don't want it to go with the property. Okay, but remember, there are certain things that have to go with the property. I can't take a sewer line out because I don't like it. Okay, I hate the sewer line. I do not want to pay for Bob's sewer line because I'm not hooked up to it. Okay, unfortunately, here's the problem. I can't take it out. So down the road, when, you know, 100 years from now, when they tear my house down and they build the new floating space age house, which, you know, has lights on it and it floats about 10 feet above the ground, guess what they're going to do? They're going to hook it up to that sewer line. All right, when they build the all new house on there and just bulldoze my house over 100 years from now, do you think they're going to hook it up to the septic? No, they're not going to hook it up to the septic tank. They're going to either have some space age, you know, nuclear reactor that, you know, they're hooking it up to now that, you know, turns our sewage into usable waste or whatever, or they're going to hook it up to that sewer line that I just paid for, because I can't take the sewer line out. That's the test. Does it go with the property? I cannot take the sewer line out no matter how much I hate it. All right, I hate that sewer line. I do not want it. I do not want to pay for it. Does not matter. I cannot take the sewer line out. I can go. I suppose I could actually go out there with a jackhammer and try to, you know, take it out. Then I spend, you know, a lot of years in prison.
Yeah, I was gonna say that.
But you know, I mean, for destruction of public property, you know, that would probably be a bad thing. But I can't take it out. You know, the street light that I don't want to have there. You know, the widening of the street, and I don't like the curb there because, you know, the ding dong up the street now walks up and down the sidewalk and lets his dog poop in my yard. Okay, because now he walks up and down the sidewalk they just stuck in. I don't want the sidewalk there. It was better when there was no sidewalk, okay, because he wasn't walking his St. Bernard up the street. All right, and I was like, I hate this. Now I got this sidewalk here, and they got this St. Bernard that, you know, Tina, when she goes out here in her jogging outfit, goes jogging past it, and every time they come by, her St. Bernard poops in my yard. Okay, I hate this. I do not want this sidewalk in front of my house. Do I have a choice? No. It was a street improvement. And guess who had to pay for it? Because there was a special assessment on it. Because they put in the storm drain stuff. I had to do it. And where does that special assessment go? Right with my property. Because I can't take it out. Oh, you know how much trouble I'd be in if I went out there and started taking a sledgehammer to it? That would be short-lived. I would be out there with a sledgehammer. It would take about 15 minutes for the cops to get there. Probably less. You know, as I'm out there beating up the sidewalk. Okay? I cannot take out those improvements. So look at it that way. Is it something that I can take out of the property because I don't like it? No, I can't. So it's part of the property. Same thing like this. Can I burn down my house and legally get away with it? Probably not. Okay? So if I build something on my property, it's with that property. I'm not going to go out there and knock it over and not have somebody look at me a little strange. Not going to go out there and set it on fire, okay, and not be arrested for arson. It's going with the property from that point forward. All right. That's the idea behind, is it a repair and maintenance, or is it something with the property? Okay, that's the best way to look at it. Am I going to get in trouble for beating it up and trying to take it out? That's a very good test. Ask yourself that insane question. That is probably one of the best questions you could possibly ask. If I go out there and take a sledgehammer to it, am I going to get in trouble for it? Look at it this way. I hate to tell you this, but if you go out and take a sledgehammer to your car, are you going to get in trouble for it? Probably. Because when you're out there taking a sledgehammer to your car, somebody's going to call the cops on you. So you know you probably have to depreciate your car because there is basically a basis cost for it and everything else.
Yeah, but you can take a sledgehammer to your kitchen if you're improving your kitchen.
True. Very true. But most people won't see you taking the sledgehammer to your kitchen. Good point. Uh-huh. And if the house is a slum and you do take a sledgehammer to it, yeah, they'd probably say it's an improvement, especially if you're out there with a construction dumpster that you're going to throw those pieces into. So there's a little bit of common sense behind that thing too. But if you have a brand new curb that was just put in, if you have that brand new curb that was just put in and you are out there beating up the curb with a sledgehammer, somebody's calling the cops. Okay? So that's one of those things. If you're out there beating up the curb and they know that you know. Oh, okay. Another message. So that's a good test. Okay? That's basically, it's called a common sense test if you want to put it that way. Common sense dictates. If you go out there and beat it with a sledgehammer and you know the cops are probably going to show up after doing so, it's probably something where there's value in it that's supposed to stay with it. Okay. Now, if you're out there beating your computer monitor with a sledgehammer, some people will probably not question that a whole lot. Okay, because it may be your personal property. So that's kind of how you need to look at it. All right, because if you are out there doing that to most public property or things like that, or big items, they're going to look at it like you're a little weird, and they're going to call the cops. All right.
Yeah.
And that's probably your
Yeah.
best. That's probably the best guideline I can give you. All right, which means that is a basis item, and if it's something that's added, even though you don't want it, and you know if you take a sledgehammer to it, you're going to get in trouble, that means it's probably part of the basis. Okay.
Okay.
All right. It is already 1:10. We are done for the day. That is all of Chapter 7. Next one we're going into is a big one. It is the depreciation and amortization one. It is probably going to take 2 sessions to do that one.
Okay.
Because it is got a lot involved with it. So prepare for it to be Wednesday and Friday.
I mean, I've been having a lot of trouble on Wednesdays and Fridays, but I really will try to get this week.
Okay, because this one's a hard one.
Yeah. I
All right,
understand.
only because it's not hard at all in regards to what it is. Okay, it's really actually pretty simple. You're just depreciating things over time. It's trying to remember all the rules. All right, and I'll try to get you some things like those publications that I got you for this one.
Oh, that would
Please
be
read
awesome.
through. Please read through those publications. That'll help you.
Okay.
All right.
Yeah.
Okay.
All right, lady. Thank you guys. You are doing awesome. I just want you to know that.
All right.
Okay.
See you on Wednesday.
You got it. I'll see you guys
Bye.
Wednesday. All right, bye.